And in three, two, one. Hello and welcome to another episode of Guide to the Grind, where we cover mindset, money, and momentum. My name is Jeff Eady. Joining me, as always, is my good friend, one of Canada's favorite mortgage brokers, and the foreplay to my sexy time, Mr. Jonathan Tilger. Jonathan, how are you today?
You had to start off making it weird, didn't you, today?
Well, yeah, he did say you were Canadian.
Yeah. No, all I say, the good thing is we live far enough away from each other that he's not right beside me when that's going on. So I'm glad to say that's the case.
Yeah.
But you had to start weird today. Other than that, I'm doing phenomenal, Jeff. How about yourself?
I'm great. I was working on that one all morning. I've slipped on a couple of them. I had to make this one good. Super excited about our guest today. I've been reading through all of his stuff and the projects he's working on. I can't wait to get into this conversation. So without further ado, I'll read his intro here. With over 27 years of experience, he's been involved from start to finish on over $425 million in construction projects, such as multifamily, professional office buildings, city halls, fire and police stations, schools, industrial, and mini storage, along with his knowledgeable team at Shannon Robnett Industries, SRI. Shannon is dedicated to sharing his expertise and delivering top quality projects that bring in numerous passive income streams to his syndicate partners. Please welcome to the show today, Mr. Shannon Robnett. Shannon, how are you today?
Good, gentlemen. How are you?
Fantastic. Thanks so much for joining us. I understand you're coming to us from Boise, Idaho.
Yeah. So I've been in Boise for 42 years, and it's a beautiful fall day.
Yeah, that's awesome. That's awesome. I've never been there myself, but big fan of Russell Brunson, and he speaks very highly of the area. So
Yeah.
looking forward to hearing more about that and what you do. Why don't you start us off with a little intro about what you and SRI does and how you create these passive income streams for investors?
You know, I grew up in a real estate family. In fact, so much so, my father was a developer and a industrial builder, and my mother was a third generation realtor. But I was so ingrained in the real estate world that when I read Robert Kiyosaki's book, I was really unimpressed. I couldn't figure out why the rest of the world was going cuckoo for Cocoa Puffs over this thing. Because that was normal dinner conversation. And I realized at that time that I didn't realize at that time, I realized about 15 years later that I was raised by poor dad. And I was raised with the mentality that I never knew my parents had money until they retired at 50 with cash flow. I knew they worked hard. I knew that they owned property, but it didn't really dawn on me until that point. And I started my own companies back in 1999. I've been working in construction my whole life. And when I saw my parents retire with cash flow, I knew that real estate investing was my future. It had to be, because every time I finished a building, I quit getting paid and I had to go find more clients and I had to feed the machine. But my parents didn't. And I've watched over the last, 25 years, they retired in 2001, that every time gas goes up, the price of chicken goes up, so do the rents of their tenants. And so they've lived the same lifestyle that they retired on in 2001. And there's not a lot of people that have investments that can tell you that same story. So in 2001, I went and did my first investment for myself. And it was an industrial complex. And here we are 22 years later, and two of the original tenants are still there. And they've paid for the building. They continue to thrive and their businesses continue to do what they do. But I just saw that was the way to go. And as I began to do more projects, I began to very quickly realize that I didn't have enough money to do all the opportunities that were available to me. And so I began to find single check writers, one guy to partner with, two guys to partner with. And we began to do projects. We kept doing projects. But in about 2017, I started a 180 unit apartment complex, and my check writer was a single family office, and they wrote checks for about $19 million. And I realized that the three other projects that I had on the board to go right behind that was going to eclipse their ability to participate. And so I began at that point to syndicate capital. And since then, since we started that in late 19, we raised about $63 million in syndicated capital through different funds and through different syndications for the projects that we do. And currently we have 2 apartment complexes under construction, and we're getting ready to start another industrial complex in Florida. We just purchased one in Houston, Texas this year, and we've got about 3 more on the board to complete in the first quarter.
So one comment I'm just going to start with, and then I got a question I just want to ask. So, and this is something that I came across years ago when you talk about just real estate as an investment. It's kind of like planting an apple tree, where every single year you got that harvest that comes in, but it does not touch the value of the tree. In fact, that tree continues to go up because that harvest continues to grow over time.
Right.
And yeah, the value of that apple will continue to increase year over year. So basically, yes, it's one of the best things to protect your money against inflation while producing a cash flow that you don't actually touch the principal on over time.
Right. I mean, if you look at that first complex that I did, it's more than tripled in value in the 22 years. Plus, I probably, if I added it up, I probably received the value of it again in rent, right? It's paid off the loan. And so, you know, when you look at that analogy is really great, because year 1, there's not hardly any fruit, if there is any. Year 2, there's some, but that rent increases are continuing to grow that fruit. And it's really, you know, Jonathan, only been in the last couple of years where people have made the kind of money they've made in real estate just on the transaction side.
Yeah.
And it's motivated a lot of people to sell some things in 18, 19, and 20 that I'm sure they're not really thrilled about having sold now.
No,
Absolutely.
very, very much the case. But the question I had was just on, you talked about syndicated sort of syndicated investments. Can you just touch on that? Because I know a lot of people don't really understand what that is, or I mean, I know some people, it's become a bad word in certain circles where syndications have gone bad. So can you just sort of touch a little bit on syndication and how that works for yourself?
Syndication, in my opinion, is just a fancy word for partnership. And in that, you have 2 participants. You have the general partner, who that would be the person pulling all the levers and doing all the work. And then you have the limited partners on the other side who are putting up the capital, and that's their only role. So it's a very symbiotic relationship because everybody knows their role and they only do very specific things. Well, in that partnership, the general partner is rewarded for how well the project does, and the limited partners are rewarded based on how well they picked the horse they're riding. And I think, you know, you're right that syndication has maybe become a little bit of a bad word because everybody and their dog has jumped into it. But I think, you know, syndicators are like doctors. There's some that are really good that have been doing it for a while and have a lot of experience. And there's some that are fairly new and they got it right most of the time. And then there's some that are just downright terrible.
Good way to put it. Who do you typically look for in these syndicators? Is it like accredited investors? Is it funds? Is it family offices? Because you mentioned kind of, you know, the higher end of the scale there.
Because I come from a construction background, I like to do everything the hardest way possible. And so we've grown most of our syndicated capital has come from just your average Joe. We've done a lot of growth in our network. So we do have a couple of registered investment advisors that work with us, but that's not where a majority of our capital comes from. And I would say about 3/4 of our capital is non-accredited investors. So we've developed a relationship with them. We've taken the time to educate in most cases on, you know, we do a lot of, we have a lot of video content about market studies and what's going on in certain areas and why we like this and how to underwrite, all of those kinds of things. Because I think honestly, and Jeff, Jonathan, maybe you guys can agree with me on this, that I think 2008 could have been avoided if we had more intelligent investors. And if 100%. People really knew what they were getting into, what a negatively amortizing loan was, or how supply and demand affects things, or what good markets are to invest in, just because you can buy something for cheap or cheaper than elsewhere doesn't necessarily make it a better investment. And so we spend a lot of time doing that, and we have a lot of education that helps people understand what is the real, what's the real method behind the madness that's going to show whether or not this is a good investment and whether or not this is something that becomes survivable should things rapidly change, hence the last 12 months.
Yeah, the last 12 months have definitely been interesting. Are you finding people are more timid to invest with you right now, or do you find that like you've got a lot of confidence within the people that you already have and you don't need a lot more new people coming in?
Well, I think that, our deal flow is definitely picking up. We're seeing a lot more things. There's a lot less best and final opportunities. There's a lot more time on the market. There's no more $1 million non-refundables. But, I divide those people into two categories. The people that have been doing it for any length of time. I was just talking with a mortgage broker friend of mine on the way into the office this morning, and it's only been the last 3.5 to 4 years that we've seen rates under 7.5, right?
Mm-hmm.
So if we look back at that, if you've been involved in real estate for the last 4 years, this is a shock to your system. If you're old dogs like us, I did that first deal I mentioned at 9% interest when I did my construction loan, right? So these are not shocking pricings on mortgage. It is a shock when you compare what you've got to pay for a mortgage rate right now versus what people want for a cap rate. There's a disparity there that's got to be reconciled, and it is being reconciled. But I think that there's still a lot of opportunity, and I think that most of our investors, we have about a 95 to 98% reinvest rate. So when
Wow.
people work with us, we meet or exceed because we underwrite conservatively. I've been through market cycles before. I've got a deal right now that we're under construction on that I originally put the land under contract in 2019. So here we are 5 years later, getting ready to finish the first phase. My underwriting never did take into account a 2.5% interest rate at the takeout. It always anticipated a 6.5% interest rate at a takeout, which is still within grasp on a fatty Freddie product. And so we're not that far off. We've also seen rent increases from my original pro forma up $700. So, it really comes down to the experience level of the investor. I think anybody that's, like I said, anybody that's been in the market for, let's call it a decade, is seeing that real estate is cyclical. This is another cycle. And I know for a fact, having gone through 07 and 08, there was a lot more money made in 9, 10, 11, and 12 than there ever was in the buildup to the 08 crash. And I anticipate this to be the same way. I'm not necessarily predicting a crash, but I do think that on the down slope of this market, there will be more money made because I think pricing's becoming realistic again.
No, you're absolutely right. And over the last, say, 5 years, 4 years, it's amazing the feeding frenzy that has happened and how do I say it? The positioning that any listing agent or has had, where you said that the $1 million non-refundables, or take a look at it. If you don't like it, too bad. We've got 10 other people lined up, and you don't have
Right.
time to get your conditions satisfied, and all these things. And
Yeah.
it's been absolutely insane. And it's anytime that the market is like that, it has to come back the other way and bounce.
Right.
It
Well,
can't stay like. Sorry, go ahead.
No, I couldn't agree with you more. But the other thing too is that we're seeing. I mean, we had conditions that I don't think anybody's ever seen. Non-refundable $1 million earnest monies, 60-day closes on $60 million deals, best and final. Who ever heard of this? The whisper price, right? I mean, when everything was just a call for offers, what the heck was that all about? I mean, so there was a lot of things that happened in the market that drove a frenzy that we're now recovering from that hangover, right?
No, absolutely. So let's talk about the projects that you work on. I'm interested in your strategy because it seems like you do every style of strategy except for single family and multifamily. Single family. Do you build from the ground up most of the time and then hold it? Do you sell it, or do you do a lot of value add?
I would say that 70% of our business is primarily ground up development. If you think of ground up development, it is the original value add. right? You take the sticks and stones and you add the tenant, which is where the cash flow is, which turns it from a merchant build to an investment product. And so we've intercepted that and we've said, hey, with my experience as a merchant builder, I can build this product. As my experience with a developer, I can develop this product. And with my experience as a syndicator, I can ensure that our LPs are going to be profitable on this venture. And so all said and done, we've been able to repeatedly take that largest slice of the pie, because you got to remember, when you're buying a value add, you're buying somebody else's upside. They've taken it from 20 million to 22 or 25 million, and they're exiting after having put lipstick on that pig 4 years ago. Got it all dressed up, new deck chairs by the pool. The Tropicana now became the Cabana Club, and they've done these things to it and they've added that value, but that's where they're going to exit. And now it's your turn to take it from, this to this. But I've never seen a C minus property turn into a B. I've only seen a C minus become a C plus, right? I mean, you've got 9-foot ceilings in most new residential product, but I think that transitioned in about the 90s. So anything older than the 90s, you're not raising the roof on that. You're not changing the design that includes common area amenities like dog washes and open space and dog parks and all the things, the Wi-Fi and all the things that are built into new product. You're never going to do that. And so there's a limit as to what the value add can do. And so, we always like to be able to offer the kind of returns that development offers, which is, up until the last couple of years has been significantly higher than value add. The last couple of years, everything's been going through the roof, and it's been a little bit of a misnomer, but it definitely is the primary source of our business. But we do a lot of value add that are light lifts. We took down a project in Houston, Texas earlier this year. It was an industrial complex that we were able to assume some 4% financing on. And that was with life insurance money. So we had 9.5 years left on that deal for the bank paper. And then we saw that this gentleman had built this new complex in 22 and tenantized it during COVID, 21. And so all of his rents were low. They were about 7-8% under market. And Houston has had quite explosive industrial rent growth. And the other thing that he hadn't done is there was no escalators in his rents. And so we were able to buy the project. And then as the leases came due, we renegotiated those leases that we've raised rent to market. And we have we've signed them all to 5-year leases. And then we've added a special clause in there that we've had in our product for the last 20 years, where on industrial product, the rent will go up 3% and or CPI, consumer price index, whichever is greater. So as you can imagine, in 22, we took a 9% rent bump on most of our properties, which everybody was super thrilled about on the investment side, not so much on the tenant side. And they all became aware of that little clause that was in their lease.
Make sure you read the fine print next time.
Well, that's the benefit of the triple net leases, right? The triple net lease is really designed to engage in a long-term lease and keep it fair, right? I mean, the reality is I can't control what property taxes do. I can't control what insurance does. I can't control what the guy's going to charge me to mow the lawn. And that's why those are pass-throughs on the triple net. And it really protects the landlord, but it also protects the tenant, because the tenant can enter into a 5 or a 10-year lease. They can build their business in that location. They can really invest in the property and know that this is going to be a long-term home for them. And that fairness goes back and forth. So we pass through the expenses on the triple net. We know that the leases are going to escalate at a 3% rate for the last 25 years. But then all of a sudden we get a couple of nice rent bumps that keep us current with market.
Do you control the paperwork when you write deals?
Absolutely.
Yeah. No, you know what?
What's your next tough question? Is the Pope Catholic? I mean,
well, I mean, even on the purchase and sale agreements of the properties.
Oh yeah.
I was taught, from one of my mentors, that whoever controls the paperwork, it's up to the other lawyer to figure out what you either put in or left out.
Yeah. Well, I'll give you a perfect example. We're in the process of finishing a 190 unit apartment complex that like I said, I put under contract in late 18, early 19. And it was a 15-acre parcel that was inside city limits, but had never been annexed. And so there was a whole process that needed to happen with that annexation, going to city meetings, getting your project approved. There was all kinds of terms and conditions that the city could and would put on you, but that was all unknown. And this family, mom and dad had passed away and the kids had inherited it. And so like I do with all my development deals, I wrote it that I put the property under contract, and I would put up a $500,000 earnest money, and that would be contingent upon me receiving city approvals for X number of units. And then after that, I would close within 30 days of that approval. And at the time those approvals were given, the earnest money would be released to the seller, not non-refundable. It was released to the seller. The one caveat that I put in there was not only that I had to receive approvals, but my earnest money was a promissory note. So I literally tied the property up for a year and a half while it went through the approval process, which was extremely long for us. We were thinking it was going to be 6 months. There were some issues with the property, not with me, that took us a year and a half. And I kept that property under contract with a piece of paper. And so by understanding, to your example, by understanding how to write your contracts and how to control that family, unfortunately for them, was bound to me. But what I didn't negotiate with them was their purchase price, because, if I know that I can put 200 units of apartments on there, I know that I can pay what they're asking. It's the variables. And if you can eliminate the variables, I can give you the price you want. And so we found that to be an equitable deal at the time. They weren't thrilled that it took 18 months. But at the time we got it done, we closed and everything was happy.
I think that is something that people really don't spend enough time looking at, is how they can get the paperwork to go to their advantage. Yeah. Everybody's looking for the deal. They're looking where they can make money, but they don't understand, like, you literally bought that property with no money down.
And what I did was I did everything that the seller needed, right? So if I failed, let's say that I got it all approved and everything was happy, and I failed to close. Number one, they had a promissory note personally guaranteed by me, right? That was held at the title company. So they were entitled to $500,000 for my aggravation of them. But they also had everything done. If I won, they had everything done to sell it to the next guy as an apartment complex. Mm-hmm. So they were also in kind of a win-win situation. I think we spent about $80,000 on all of our due diligence and everything that we did there. So we expended real money. We put them in a better position should we have failed. But you're right. And again, Jeff, I would challenge people to look at how long they've been involved in real estate. And the big thing that you've got to ask yourself is, how do I solve the seller's problem? And a lot of people don't bother to ask, why is the seller selling, right? They ask because they're curious, but why is the seller selling? Well, he's ready to move to another project. He wants to do this. He's retiring. He doesn't want this. But by finding out how to truly, really honestly solve the seller's problem, you find the way to write the paperwork to your advantage, because the seller sees that you're meeting his need. And in this particular case, it was a family of farmers. It was the last parcel that was left. And, they wanted to maximize the value. This is their final send off from mom and dad. And this was what they were going to split 3 ways. And we were able to solve that to the highest number. And that's really what they were after. Sometimes price isn't really what they're trying to solve for. And so there's a lot of ways to underwrite and to do other things that write things more favorably, but give the seller what they're truly looking for to get out of the deal.
I think that's huge. At the end of the day, any transaction involves 2 human beings. It's not the property, it's the person. We recently were working on a deal where the purchase price was 1.2 million, and I told the realtor offer him 950. That's right, 850. And he's like, oh, I can't do that. I can't do it. And he did, because we told him to. And they came back with 950. Mm-hmm. I'm like, we don't know what position they're in. If they're not willing to entertain it, then let's see what they're doing. And we offered them a VTB at 8%, and they came back with 9%. Right. So if you're not willing to ask these questions and try these things, you're never going to get ahead with the purchase. And that's where you make the money most of the time, if you find the right spot.
Well, and I'm sitting in my office building, which was another purchase that it was a 44,000 square foot office building that was being sold 2 years ago. We closed on it December 16th of what was that, 21, and it was being sold at a 7 cap on existing tenants, and it was about 65% occupied, and most of those tenants were month to month. And there was a major tenant that occupied 12,000 square feet. That was not going to renew and only had about 11 months left on their lease. So it was and it'd been on the market for 2 years, right? And so I put it under contract at full price, and we went through all the due diligence, and I figured out that this building was built in 1980 and it was literally all original. I mean, literally everything was original. So it needed about a $2 million overhaul. And my bank obviously said no. And I had financing as a contingency. So then I called the seller up and I said, hey, I got some good news and I got some bad news. And he goes, well, what's the bad news? I said, my bank obviously turned down the loan. And he goes, well, what could possibly be good news? I said, the good news is you're going to do a seller finance. He goes, what? And I said, yeah, I got 20% down waiting here to close, and I can close in 30 days just like we'd planned. And I'll buy the deal and you give me 2 years at 6%. And interest only, and we got a deal. We'll move forward. Well, these guys had bought the deal 8 years prior. They were in the money on the deal. They were going to do a 1031 exchange in a hot market. This alleviated a lot of that because they only had to exchange what they received. Mm-hmm. So it really solved a lot of problems. And by doing that, we now have the building completely remodeled. We're at 91% occupied. We're going out for permanent financing on that with a $10 million value, and we're in at 6 million, right? So we were able to make money on the deal by solving their problem. They had something they were not going to put another dime in, right? They bought it for $2 million. They weren't putting any more money in it, right? But they wanted to get it sold. They wanted to harvest their profits. Now, as things work out for them, they're going into a market that's definitely a lot less spicy than it was when they were selling. And they're probably going to wind up actually making more money between the transaction and what they purchased than they would have been able to 24 months ago.
Yep. No, that's just such a great way to look at it. Having a win-win in a situation. Have you ever read Art of the Deal?
Oh, yeah.
Yeah, great book. You know what? One of the things I loved in that is everybody thinks Trump's was so cutthroat, but he's like, no, you have to let the other side win too. Mm-hmm. Otherwise, you're never going to be able to do business with them or anybody else that they know.
Right.
And I just
I had the privilege of having lunch with his attorney,
George Ross.
Yeah, George.
I know George.
And what a fantastic guy, right? But you listen to the stories that guy has, right? And that guy was such a key component in finding out what the win was for the other people,
100%.
And by the time they got done, they had met everybody's needs, right? They got the wants, needs, and desires out on the table. They solved for X. Everybody won on that, but obviously Trump was the biggest winner, right?
Yeah.
But it comes down to that art form. It comes down to that understanding of what are you trying to accomplish and why. And if you're just in it for you, yeah, you might do a deal. But if you're in it to make that happen, I know that the people that I bought this building from have a portfolio of stuff that they bought that was underperforming when they bought it. And I'm sure when we final this out here next month and get our permanent debt on it, we'll be back at the table talking about some of the other stuff they got.
Yep, absolutely. Just as an aside, Jonathan and I actually met because of George Ross.
Okay.
I brought.
So he's the matchmaker in your fun time.
Yeah,
he is, yeah. and I got to have lunch with George Ross as well. So I'm.
I don't know that George Ross wants to add that to his resume of matchmaker.
You know what? He's a great guy. I had the good fortune of meeting him through a friend of mine. I brought him up to Toronto to do an event, and Jonathan attended the event and bought the charity lunch to go down to New York and have lunch with him. Yeah, no, great. I learned a lot from George. When I was talking earlier about somebody teaching me about controlling the paperwork, it was George.
Absolutely. And it's not that you're trying to slide something in there, but it's like every kid at Christmas, I'm old enough that my parents used to toss me the Sears catalog and say, let us know your Christmas list. Right. And obviously we were going to be thoroughly disappointed because circling a whole page didn't count, right? I want all of this, but at the same time, you had, you're getting something, right? And you're putting things in there and it's for them to take it out. And if you don't ask, you won't know. You found that out just a couple of weeks ago with this, or just a couple of days ago with this latest offer. If you don't ask, you don't know. And if you don't ask, shame on you.
Absolutely. As an aside, my interest in the toy section of the Sears catalog waned as I got older.
Well, I knew you were going to take it there. I knew as soon as I said it, I'm like, not only am I going to date myself, but I'm going to open this up for a racist comment. I'm surprised, honestly, at how tame that one was.
Well, I do try and keep it PG here.
Yeah.
So do you sell most of your buildings, or do you just continue to grow a portfolio for yourself and your clients?
Over the last couple of years, I'll give you an example. We had a project that was in an opportunity zone. So an opportunity zone was a Trump created tax benefit area that had to do with economic redevelopment. And there's a whole lot more that goes into that, but the goal is to get people to spend money in underdeveloped areas or older areas of town and then hold them for 10 years. We hit our 10-year goal with an unsolicited offer on the building, and obviously we sold. So we sold that building last July, and now those investors have reinvested in, again, they came from this point, they reinvested at the bottom on another development. And so they're in the money for sure, but it's definitely, we'd like to hold our product. We're buying more investment grade product that is, right now there's a lot of product in the market that's cash flowing, that's good deals, and more is coming. And so we're able to position that way, but building a portfolio is our goal. But, holding out past the point of reason, because we do have the opportunity to leave one investment at the peak and take another one at the bottom. We're never lacking for deal flow, but just to churn paper isn't our goal at all. No.
Mm-hmm. And how invested are you personally in the project?
So this is a big argument among syndicators, right? There's a lot of syndicators that run their model that they're getting 20 or 30% of the upside. The LPs are bringing 100% of the cash. And I think that that's really an improper weighting of one's ability. I think that very highly favors the syndicator, and it's unfair. So my model is this: I put 5% of the equity raised in my own personal funds, and that is not phantom equity. When we rezone a piece of property and we increase the value, we put that into the deal at the purchase price and the cost of the plans. We do reimburse for office time that was required, but we do not upsell that or mark that up as it goes into the deal. So if we're raising $10 million, I'm going to put 500,000 of my own capital in on the LP side. And then at the distribution side, at the end of the project, mine is a true waterfall. So until my investors make 12% or better, all I'm ever getting is the same as them on the LP side. I have no opportunity for upside bigger than that 5%. After that, it graduates pretty quickly that if I get my investors over a 23% return, I'm taking 65% of the money upside of 23%. Mm-hmm. But then again, I underwrote it for 17. We're at 23. The last exit we had was 104%.
Oh.
So, and
Nice.
to be clear, Jeff, that was the market, not me. As you guys can tell, I got a face made for radio, so they weren't buying it because I owned it. But at the end of the day, my investors did very well. I did very well, but I was motivated at every step of the way. I had my cash into it. I had my time into it. And the better the return, the better I got paid. Mm-hmm. And I think that's a more accurate and a fairer model for all involved.
Absolutely. I've heard a million different models, but I love ones that look like that because A, you're invested alongside them, and B, you're not dipping your fingers into the pot before anybody else gets them.
No. And, it's always a question that comes up, how much money do you have in this deal? Well, yep. I am usually the single largest LP, right? Because I have 5% of the equity. I do have a couple of guys that, you know, that they write $1 million checks, and that's fabulous. So in some cases, they are the single largest LP. But, you know, that's a very comfortable position for LPs to come into when they know that you have a very large slice of your own personal money to lose.
Yep. Yeah, and that, you know, the interesting thing, Jonathan and I work with a lot of family offices and institutional lenders and such. And the three questions they ask is, how much skin in the game do you have? What's your experience? And do you have the offtake agreements to support your claims?
Yeah.
And without, you know, that's the trifecta. If you got those three things, it's really easy to get a deal done.
Right.
But if you're looking to get your first deal done and you don't have any skin in the game, good luck.
Right. Well, and family offices are, you know, a couple generations prior, somebody made the money, and they usually have professional management in there to make sure that they're not losing the money and they're getting a modest return because they have enough to live on. So they were smart enough to hire experience to manage the money. Now they're wanting another level of experience in there. So experience does matter. And it's something that a lot of people overlook because they saw a pretty spreadsheet that advertised a number that may or may not have been practical. I mean, I've seen deals in the last 2 years that were underwritten. They were purchasing it at a 4 cap, and their plan was to sell it at a 3 cap. I don't know anybody in their right mind that underwrites to sell at a lower cap rate than they purchased at. That's anticipating market only getting better, right? And you know, that's kind of like being at the bar. The later you stay, the better they get looking, you know.
And here we are back to it.
I figured if you could do it, I could do it, my friend.
One of the comments I remember hearing years ago, which was there's never a pro forma that looks bad.
No,
When it comes down, you got to look at really what are the assumptions that have gone into that pro forma.
That's correct.
And as you say, what are the actual projection numbers? And if what's being put in is unrealistic, well, we're gonna finance this at a 3% interest rate going.
Yeah.
2 years ago you could have, but we all knew that wasn't going to last. And if that's what you're expecting for this thing to make money, you're dead.
And, you know, the funny thing is, I think if you look at the people that are, again, have been in the real estate for over a decade, they weren't putting those kind of time bombs in their underwriting. The people that were jumping in on those deals were the inexperienced people, which is one of the main reasons we go back to education as a foundation over here, because we want to make sure that you understand what good underwriting looks like. It's not because we show you only our underwriting. We show you what good underwriting looks like so that you can see a red flag. And then when you compare that back to the resume, while they may have had some very successful exits in the last 3 or 4 years, when was the last market like this that they've navigated? How long have they been doing this? Have they seen a deal go south? You know, I mean, anybody could have made money in the last, you know, in 21 and 22, right? Well, maybe not so much in 22 for some people, but, you know, at least in 19 and 20 and 21, they were making money hand over fist. But it's the wrestling of the alligators that puts the stripes on you that makes sure that you understand how to get out of this mess. You know, I remember my approach to this market is much different than my approach was in 08 because of the lumps I took, because of the things that I had to fight through and I had to manage and I had to juggle and come up with solutions for back then that have tempered and really changed how I do business for the better, so that when things happen, it's not an if, you know, it's a when. And when things happen, you've got to be prepared to handle it. And if you're not, then you're going to repeat until you figure that part out.
There's a book by Dan Millman where he talks about if you continue to make the same mistake over and over again, the universe punishes you. And sorry, it doesn't punish you. The consequences of those decisions become more severe each time.
Yes.
Not to punish you, but to make sure you get the point.
Right. It's obvious that, you know, you need to learn from the dumb end of a board. And, you know, I can't say that there haven't been lessons that I've had to learn 2 and 3 times. Right.
Yeah.
But I guarantee you by the 3rd time I learned it, it was extremely painful. And it's now in the no-go zone of my life. Right. You just, and you learn that. Right.
That's like an ex of mine.
Here we go again. Right?
That one didn't involve foreplay with me, did it? I hope.
Oh gosh. Jonathan, I hope that doesn't flash across my mind at any inappropriate times.
I just hope it never flashes across mine.
I told you we like to keep it a little lighthearted. I mean,
Yeah,
it's a serious
no, I love
topic,
it.
but at the end of the day, nobody does real estate because it's fun. They do it because they want to make money. But what if you can have a little fun while you're talking about it? Because
Absolutely.
I love having these conversations because
Yeah.
I learn every single time. And I love hearing, I love hearing folks like you that have been in it so long that have that conservative view on it. Because George actually taught me, he's like, Jeff, the market's cyclical. About every 13 to 15 years, you're going to have a correction. It's just the way it is. It's been that way since the dawn of time, and it's going to be that way for the rest of your life. And here we are right at that 15-year mark, and we're seeing it. The scary thing for me is the regular folks who have gotten in over their heads.
Right.
That's the one thing I hate seeing, because there are people who just they're at the point where they're not going to be able to afford their mortgages.
Yeah.
But on the upside, as investors, it's a great time to be getting in the market as an investor.
Completely agree. I mean, the reality is, and I've always had this philosophy because, like I said, I did my first deal at 9%. If the deal pencils, I don't care what the interest rate is. If the deal will pencil and it will cash flow from day one, you may be looking at it when when we bought that deal in Texas earlier this year, we looked at it and we thought, you know what, we're assuming 4%. We might go back to 3, and maybe we could refi and get better, or we could finance it now at 6. We did another deal 3 months after that we financed at 6.5%. And even that today looks like a great deal, right? So if interest rates go up, it's a great deal. If interest rates go down, you can correct the problem, right? What is it? Marry the property, date the mortgage, right? But the other side of that is if the deal will pencil and it will cash flow, and it's a legitimate deal that has good solid tenants and good rent history and all of those kinds of things, or has good upside in the market and need in the market, there's really no reason not to do the deal. Fear is something that is not calculatable. And so it takes a lot of people out of the game because they don't understand their numbers. I can literally stand on my underwriting and go, this is a good deal. I can send it to the bank. The bank goes, this is a good deal. They loan the money. Money's locked in. We're good to go for the next 5 to 7 years. We may see a depression in the price when we go to sell, which means we're probably not sellers, And so that's the thing that I think a lot of people have lost sight of over the last couple of years, is that they've been day trading with real estate. It's not a 6-month commitment. It's not a flip it in a year kind of a thing. And I think that those people that, like I said, did sell in 19 and 20, 5 years from now are going to have a lot of regrets, because you're seeing inflation take its toll on who could buy. We had 7 to 9 million housing units short in America in 21. Then we threw COVID in on top of that slowed it down some more. Now we've thrown in higher interest rates that have slowed home building down to 1995 levels, I think I saw the other day. So we're exacerbating the problem. So housing is still going to be needed because the population continues to grow. And then you look at that and you go, well, what happens when a supply and demand issue hits? It doesn't matter what mortgages are. My dad started his career and was selling houses, single family homes, in a 16% rate environment, right?
I was just going to say that. Yeah.
So it's not going to change. But those houses in 1970 have gone up 7 times. I mean, so there's still a boatload of money to be made, but it's a long-term horizon. And, we saw a lot of institutions position even in 21 and 22. And everybody was going, well, gosh, how could you have afforded to pay that? I sold an apartment complex at a 3.75 cap. Well, that institution bought that January of last year, and they're now at a 5 cap, but their goal is to hold it for 20 years. Well, I can guarantee you that they will refi a couple of times. They'll be in a much better position. Rents will continue to grow up and go up, and their 25-year horizon, they're going to look like geniuses.
Yeah. Well, that's it. Over the long time, over the long haul, real estate always goes up. There's going to be fluctuations, but it's always going to go up because they're not making more land. The classic statement about real estate.
Yeah. I just can't figure out why my weight keeps going up. I mean, And that's not appreciation. I get less appreciation the more my weight goes up. I don't, what's the correlation there?
That's equity, brother.
It's funny. Nobody's interested in refi-ing that.
I didn't think we could make real estate this sexy.
Well, you started it off with the note you started it off on. Look where we got to.
Yeah, exactly. And then you invited the guests that you invited, and really, it was all downhill from there.
Well, we're hitting the end of our hour here, Shannon. This has been awesome, and I think super informative. I have one real question for you, though. In your sales process or education process, because that's really what a sales process is, when do you see that people flip from being skeptical to, oh my gosh, I see what you're saying and I'm in?
Well, there's two things that we see happen consistently. One is they understand. I don't want anybody to invest with me or anybody else if they don't understand the deal.
Mhm.
We've all heard the guy that got in on Uncle Johnny's stock tip and they bought some of this. They don't even know what the company does, but it's going to make a ton of money. So once they understand and they've developed that level of trust, and I don't think enough people put in the time to really make sure that the education speaks for itself. And in doing that, you're developing the trust because the person now understands that your formula, the way that you conduct business, is actually very accurate with the way that makes sense. It's when people are skeptical, they're either not able to measure why this makes sense, or they don't have the trust and they don't have the understanding that says what Shannon is doing is correct. And I can follow that formula with him, with Jeff, with John, with any of these other projects. I can follow that formula and I will be a winner.
Mm-hmm. No, that's huge. That's huge. Yeah, I think we got to cut it off now. We're at the end of the time. I want to respect your time, and I think we've covered a lot in a very short period of time. So I'd love to have you back on in the very near future, see how some of your projects are going, and kind of keep an update with you, because I love to hear what you're doing, and I love to hear that somebody's out there. It sounds like you're really sticking up for the little guy, because Lord knows there's been a lot of people not doing that for the last while.
Yeah, I think that's what I like the best, is educating people, getting them to understand why they're doing what they're doing, and seeing them win, because Wall Street's not here to protect you. Your Charles Schwab and your Merrill Lynch and all those guys, they're not here to protect you. They're here to make their fees. And when you can put the power of real estate really to work with you, for you, in a passive way, it's the greatest wealth creator on the planet.
Yeah, absolutely. Thanks so much for your time, Shannon. I really appreciate it. If you want to hang out just a minute after we sign off, I'd love to have a side conversation with you. Jonathan, anything you want to leave us off with?
Absolute pleasure speaking with you today, Shannon. Really, really appreciate it. Learned a few things and love what you're doing.
Well, and I want to say thanks to both of you guys. I mean, you're taking time out of your busy schedules to help bring education and to educate people, which, I've got a very similar mission and goal. And I think it's a noble one, because people need this kind of information. They need to hear from guys like you with real experience that says, hey, we're not falling off a cliff. There's a right way and there's a wrong way. And here's some people that are doing some of the right things. And so I appreciate what you guys are doing as well.
Thank you very much. Shannon, how can folks find you?
Easiest way to do it is just shannonrobnett.com. All my social handles are there. There's even a link to our education, a couple of ebooks I've written, and a link to my calendar if you'd like to have a conversation.
Excellent. Well, again, Shannon, thank you so much for being here. Jonathan, thank you. Thank you for listening. If you made it this far and you live in Canada, that's one of the stipulations here. You want to know more about how our Equity Assist program works to help homeowners get a 20% down payment in the GTA, at least, give us a shout. You can always go to mortgageplan.com, get a hold of Jonathan, find out more about that. Otherwise, thank you so much for being here and listening all the way through. Jonathan, thank you. Shannon, thank you. We'll have a fantastic day, and we'll see you soon.